The stock market is a complex and dynamic system that is influenced by a variety of factors. Stock prices are determined by supply and demand, as well as a range of economic, political, and social factors. When demand for a particular stock is high, the price will tend to rise. This can be due to a number of factors, such as positive earnings reports, new product launches, or favorable economic conditions. On the other hand, if demand for a stock is low, the price will tend to fall. This can be due to negative earnings reports, declining sales, or negative economic conditions. In addition to demand, supply can also affect stock prices. If there is a large supply of a particular stock on the market, the price may be driven down. This can happen if a company issues a large number of new shares, or if existing shareholders sell large amounts of their stock. On the other hand, if there is a limited supply of a particular stock, the price may rise. This can happen if a company buys back its own shares, or if there are few sellers in the market. Overall, stock prices are constantly changing, reflecting the constantly changing economic and market conditions. As a result, investors must be prepared to adapt to these changes and make informed decisions about when to buy and sell their stocks.